This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a Mackenzie Investments podcast. I'm your host, Dustin Reed, Chief Fixed Income Strategist at Mackenzie in Toronto. Recording this about an hour after the July FOMC press conference finished, with, of course, the meeting finishing earlier this afternoon, and the Fed, the FOMC, deciding to leave rates on hold with 3 dissents, all from district presidents from around the country, and a statement that was effectively unchanged except for those 3 dissents coming through as part of the July official statement. This being the July meeting, of course. This is not one of the SEP or Statement of Economic Projection forecast rounds or meetings. That next one, the next time we'll see the dots, as it were, will be in September. So nothing to go through really from a economic update from the Fed in terms of forecasting and projections. The statement, like I just alluded to, was relatively unchanged from the June statement, the last FOMC before today. And the press conference was really where most of the action was. Chairman Warsh doing about a 35-minute press conference, again, about 15, 20 minutes, maybe 15 minutes shorter than what Powell had been used to and more in line with where Warsh was during the June FOMC press conference. As many people know, this was probably the most watched Fed meeting since, I would say, 2024, with a lot of people on both sides of the fence. Will they hike or will they not? And the market went in to this meeting with about 8 or 9 basis points priced, presumably with a denominator of 25 as the possibility. 8 or 9 basis points priced for today's meeting. And of course, nothing done. And so it ended up being 0. This being Warsh's second meeting, we know a number of things about Chair Warsh. One, we know that he really does not care for forward guidance and wants the markets to kind of figure it out for itself. He said that many, many times, including the last press conference in June and a handful of other appearances that he's had since he became chair in May. And we also know that he has been signaling very strongly that the committee, he likes to use the term, is laser focused on getting back to 2% inflation target. This being the second official FOMC meeting and press conference that he has chaired, the market was starting to believe that something could happen, hence the 8 or 9 basis points of, again, presumably 25, that the market was pricing in for potential Fed hikes. With the Fed opting to hold rates at the same Fed funds level, 3.5 to 3.75%, the market has started to become a little bit concerned that the language that Chair Warsh has been using is not necessarily going to be backed up by action. I would say there were a number of instances throughout the press conference, the 30 or 35 minutes of the press conference, where a number of journalists in the room asked Chair Warsh what he plans to do about getting inflation lower, given that apparently the committee and him are very, very focused, laser focused on getting inflation back to 2%. And of course, headline inflation is running well above 2%, and core PCE, which is clearly the Fed's primary inflation metric, although not its only one, but its primary, is running closer to 3% on an annualized basis. And I would say Warsh did not particularly offer a lot of granularity about what the Fed will do for getting inflation back to 2%. And watching the press conference live and watching markets live throughout, you could see that the market was becoming more and more concerned that this Fed might not be as resilient on inflation as maybe it thought the Fed might be, given Chairman Warsh's first press conference and FOMC meeting back in June, when he surprised a lot of people and came out what seemed to be quite hawkish, at least from a verbal perspective. And so far, we have seen the back end of the curve move significantly higher. The last I checked, the back end of the curve, 30-year U.S. Treasury nominal duration was trading at 5.20%, which is up about 11 basis points on the day and about at the cyclical high. seeming to suggest that there were some people in the market that are becoming concerned about, I would say, the Fed's ability and willingness, maybe a better term, to fight inflation over the longer term, and B, maybe related to the first part, that there might be a bit of a credibility issue. And that credibility issue, I think, is becoming seen in the back of the curve. We'd expected the Fed to hold today, but I would have expected a bit more of a hawkish outcome. This is clearly not that. Hawkish outcome would have probably led to what I would call a twist flattener, so where the back end of the curve yields trade lower and the front of the curve trades higher. But what we are seeing is what I would call a twist steepener, where the back end of the curve is moving higher and the front end of the curve is moving lower. And not surprisingly, pricing for this next FOMC meeting, September FOMC meeting, has moved from around 22, 23-ish basis points to about 15 or 16 basis points before I logged off and started this podcast. And that will bounce around, of course. And there's a long way to go between now and the September meeting, including all of the data, plus the big annual symposium that the Fed puts together every year in August in Jackson Hole, Wyoming, put on by the Kansas City Fed. In the hour or so since the end of the press conference and just the quick discussions that I've had with other market participants, you can tell that there is a growing concern about Fed willingness to combat inflation and a little bit around Fed credibility. Not for piling on, but Trump was, I don't know if he was speaking or on social media, but regardless, Trump said after the press conference had finished that Warsh wants to see lower rates, which I would argue is probably not what the market believes needs to happen overall, given where the level of inflation is and the fact that the labor market data clearly has surprised to the upside over the last 6 months. And we've gone from a downside risk scenario by the market for the labor market to, at a minimum, a stable labor market outlook, if not a slight acceleration in the labor market. So the market, I think, is concerned here about inflation and the Fed reaction function. Doing these podcasts so close to the Fed meetings, of course, have pros and cons. The pros is we can get, obviously, our thoughts to you as quickly as possible and make it fresh. The con is that we don't really have 12, 14, 18 hours of market trading to kind of see what the flows are going to be like and what the reaction is. But if we continue to see in the next day or two this kind of reaction function by the market, particularly in the Treasury curve, it's going to be problematic for risk assets. Again, markets closing about 15 minutes ago, right before we started this podcast, and equity markets were lower on the day, even though the Fed did not hike rates. So you have a bad day for 60/40 portfolios, as it were, with equities lower and fixed income prices lower, at least at the back end of the curve, with yields higher. And I think the equity market is probably stuck between two things. One, yes, the Fed did not hike rates. That's fine. But from a valuation perspective, the back end of the curve, 10s and 30s are higher. And so that valuation becomes more expensive for equities. And so I think the equities market is kind of caught between that, at least from a top down macro perspective. To me, the things to watch here now going forward, and we'll see if we hit it and if we go through it, but in 30-year nominal US duration, if we see 5.25 trade, 5.25% trade, and we do not see some macroprudential measures initiated by the Treasury, there is a possibility that the back end of this curve could become a little bit unanchored. And if that does become the case, then I think we could be in for a little bit of additional volatility, as we have been expecting, to be fair. But I think it would be very much cross asset volatility. So this is something that needs to be watched. I don't necessarily think that everyone needs to run for their life raft, but at the same time, we are at the beginnings of potentially perilous levels in the yield curve. And if the back end continues to move higher and the bond vigilante trade, as is sometimes called, does come into force, then we're going to be in for a volatile couple of weeks, probably with global risk sentiment offered across asset classes. The data will count here, of course. I want to hear also what other Fed speakers are saying, not necessarily the ones who dissented and voted, the three that voted for a hike today. I guess we know what they think, but the ones that are a little bit more on the fence, people like Governor Cook, people like Governor Waller in particular, I want to see what they're saying. If they seem to suggest that they are close to a hike and September is more likely than not for them in the intermeeting period, then perhaps this can stop the concern around the back end of the curve and we can kind of reset and normalize a little bit in markets. But if absent that, there's a lot of space between now and September, although, of course, there is the Jackson Hole Symposium, like I was just mentioning. But there is a lot of daylight between today, the very end of July, and mid September when the next FOMC meeting sits. So someone will have to come out and presumably say something. And I think that the Treasury itself, whether that's Treasury Secretary Bessent or one of the deputy secretaries, may have to come out and say something. Now, as it happens next week, first week of August, we have the quarterly refunding announcement by the Treasury. I recall a couple of years ago, we had an announcement that surprised the market, and we had a pretty big volatile move within the Treasury market on the August refunding announcement. This time, if the back end of the curve is looking a little bit unhinged, the Treasury can come out and talk about lowering issuance in the back end of the curve, so less supply in the back end of the curve, and adding that supply at the front end of the curve in the bill space, presumably. And less supply and, hopefully around the same demand should mean higher prices and lower yields. But of course, if less supply is also met with equally less demand, then that's potentially an issue as well. So I do think the QRA is probably the first line of defense here, reasonably, besides the odd speaker next week. But obviously, being August, there's not a huge amount of speakers slated anytime soon, with the exception of Jackson Hole. So going to be keeping a very close eye on the QRA refunding announcement next week for the first week of August to see what happens. My view here, just to finish things off, I do continue to think that the Fed will hike rates this year. And I think September is quite likely. Part of that is because I think that the data will suggest that the labor market continues to be relatively robust. Inflation continues to be high. AI CapEx spend remains very robust and pushing the US economy. And I think the fundamental data will justify rates higher. And I think some of those that were close to maybe voting for a hike that did not today will probably have we'll call it the fundamental ability to do so, because the fundamental economic progression will allow them to vote for a hike in September. I still think it's probably 25, but if markets become a little bit unruly and the data between now and September is extremely hot, and we take back some of that June CPI, PPI data, certainly not my base case, but I would not completely rule out at least discussion by the market. Will the Fed do 50 basis points in September as opposed to 25? But 25 for now is very much my base case. That's it for today in our FOMC and market wrap. Thanks very much for listening to the latest edition of Market Exchange with Mackenzie Investments. The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.